Hello and welcome to Talking Stocks. I'm Gugulethu Cele. Today we're talking Capitec Bank, the largest unsecured lender in South Africa. And here to share their expert knowledge on the investment case of this particular company is Sean Ashton and Peter Armitage, both from Anchor Capital. Good to have you both, gentlemen. We mentioned in the intro there that it's the largest unsecured lender. Is this still fair, especially given the issues that it faced versus African bank investments just last year?
Absolutely. I think this has become a fairly big business. You know, they've got about a loan book of 33 billion rands worth. And this is a business that makes a bottom line profit of 2.5 billion rands. So it's quite a sizable company. But I think further to that, it's not just an unsecured lender. They do have a transactional banking franchise associated with their business, which is a very important distinction.
Let's talk to that, because that's clearly where the interest is coming from, Peter. I understand that by the year 2020, they want to have 25% of the South African banking market share.
Yeah, I think in South Africa, there's a few examples of companies that have really created what the customer's looking for. When I think of Discovery in the health market, Capitec's very similar in the banking market, where they've come into the market and they've basically, from a banking point of view, they're taking the view of saying they're a retailer and their product is cash or loans. And I always say to people, I remember walking down my own shopping mall, not my one that I own, but near my house, you know, on a Wednesday afternoon at 5 o'clock. And all the big four banks are closed, but you've got Capitec open and doing business. And they've said if a retailer has retail hours, and they're providing a service to a client that the other banks simply aren't and can't.
Let's look at the valuation of this particular stock. I know that it does have a market cap of half the value of Nedbank, but if we look at the share price ranging between 530, touched a peak of 540, is it fairly valued versus its financial peers?
It's come a long way. So I think the share price back in as recent as September was about 200 or 230 rand a share, if I remember correctly. It's run up to 530. They earned about 22 rands a share in 2015. That's the February financial year ended. And we think that they can grow another 20 to 25% for the coming year, with that type of growth rate being sustained for a while. So that pitches the stock at about a forward 20 times P multiple. So a lot more expensive than it's been for a while. But I think it's also important to bear in mind that this business over time has tended to trade at a significant premium to the big four banks. If you look at the last 10 years worth of history, it's long been a high growth stock. It's traded anything between a 30 and 50% premium to the big four banks. And many of those are trading at 13 times or 12 or 13 times forward PEs. So I think that valuation needs to be seen in that context. And I would argue that a year ago it was simply too cheap. Now we would say, well, a lot of that price is, or a lot of the growth potential is certainly priced in. But it's not to say that if they can carry on sustaining this rate of growth, that rating can potentially be held onto.
Is the growth in the transactional market? You alluded to the university students.
Yeah, so I think, they've got a plan of more transactions per store. They're opening new stores all the time. And they're adding up to 100,000 new customers every month, which is quite remarkable. So I think they've got about 2.5 million primary banking clients. Yeah. The banking market hasn't grown a hell of a lot over the course of the last 10 years. So basically that's stealing customers. Primarily from the likes of Absa, Barclays. If
we review the 2015 full year results, it does seem as though the transaction fee income increased by 35%. Sure.
This has been a trend for a number of years. It's something we've been alluding to for a while. This business is becoming more of a transactional bank, less of a micro lender. And you have seen a bit of a slowdown in the rate at which new loans are dispersed in their market. And net interest income was up by 14% in this last financial year. Still very robust numbers, but transactional fee income grew by 35%. And that relative outperformance of transactional fee income versus balance sheet lending type of income has been in place for a long time. And that's as they add new transactional customers. And I think the important point to make about this is that when you've got an established ATM network, a branch network, and systems in place, and as you add more customers, as those people transact more and more on your products or on your services and your card, you tend to find that that's very high ROE business, because you're not having to write a brand new loan to actually generate income growth. So transactional fee income growth is very good for the business. It's very good for the return profile of the business. And it's probably much higher ROE business than pure lending.
Gugu, an important point as well is they've got the right product for the customer. So I remember going with Rion Stassen years ago to go and see a bank, and he said, there's nobody in the back office, everybody's in the front, And if you've got an ID book and a thumbprint, you can basically open a bank account. I recently opened a bank account for one of my kids. I signed my signature 43 times and spent 1.5 hours on a Saturday morning at a traditional bank branch.
Sure.
So the big banks, their systems, the big banks have got legacy systems that they simply can never integrate. They'd have to close their bank down for months. Capitec is only 15 years old. They started with a blank sheet of paper, and they've got simple systems and processes, the best in the world, that the big banks, in fact, can't compete with.
Is there still growth opportunities, though, in the unsecured lending space? I hear that despite the consumer being under pressure, but that's a particular sector that will never die.
I think it's going to be around for a long time. I don't actually personally think that that's where the growth delta is going to come from for Capitec. That is what drove their growth for much of the last 10 years. I think the growth will come from transactional banking personally, and I think a handful of new products. They've talked about credit cards as an example. The little bit of analysis that we did, now that's not a product that they currently offer, but the little bit of analysis that we did was that if you look at the big four banks as an average, their credit card customers account for probably about 14,000 rands worth of average balance per customer that they have as a credit card client. Now, if Capitec, and we know that they're going to be launching a product sometime in the next 12 months most likely, if they were to launch a card, let's say to 50% of their customer base, of the transactional customer base, we think there'd be appetite. And if you assume only 8,000 rands worth of average balance, in other words, probably 40-50% lower than what the big four banks are to account for the differences in their customer profile, that number would be an extra 10 billion rands worth of advances onto their book. And this is a business that has an advances book of 32 billion rands. So already that's a third. So I think that the growth is going to come from select new products that they might issue, like credit cards, and potentially more longer term, I think different geographies. I think they may well look to press beyond South Africa in time to come.
Which could be a significant point, because they do have the backing of PSG, and I understand there was a rights issue a few months ago in an attempt to raise capital, which they're deploying to the likes of Capitec. So with such a solid shareholder backing them, then clearly this must work to their benefit.
Sure, I think one of the secrets behind Capitec from the start is they had PSG as a backer. So they could always operate with the confidence of knowing that they had access to capital. And they come to market, Sean, probably 3 or 4 times, I can't really recall, over their 15 years, where they needed that extra, because banks need a base of capital. It's a regulatory requirement. You can work it out in a spreadsheet how much money they need. And they've always been ahead of what they need. But they could operate knowing that they could access that capital. And when your share price is high and you issue shares, then that has an extra positive boost on your earnings and your earnings per share, because you're not diluting by too much to raise that capital.
We saw the graph of the income mix on the screen just a moment ago, and that obviously goes to how it can change given the credit card sentiment that you alluded to. But it's interesting to see how it has changed from the net loan generation to the transactional revenue, really seeing a significant increase there. And as you said, that is where the growth is going to come from.
This is a very important point, because net transactional revenue was 10% of their business if you look back to 2009. It's not all that long ago. Go back 5 years forward, it's close on 40% of their overall income pot. And that's the point to make about return on equity. So these guys tend to target, I think what they've publicly said is about a 25% return on equity. In reality, we think that could become higher because they've got a very scalable business model. And as your transactional fee income grows as a proportion of the mix, that's quite capital light business. So that would tend to be supportive of a higher ROE. I wouldn't be surprised if at the top of the cycle they can achieve a 30% return.
What's important, however, is, in talking about this transaction revenue, is that something like an African bank had 0 transaction revenue. It was just an unsecured lender. And their competitors effectively have got a very different business model. From the beginning, they've set up to say, we're going to own a customer, and the customer's got their primary banking account they can lend money to. They can see what their behavior is. So they're much better placed to lend money to somebody because they've got the guy's bank account, and they can observe what all the other micro lenders are doing, because they can observe in their bank accounts what their clients with bank accounts are doing with other micro lenders. So they're placed in quite a special place in that market from an informational perspective, and from the ability of being able to garner information about the client, and hence knowing what to lend the client, because you can see their bank activity. African Bank never had that. Their behavior was simply based on credit bureau information and what the client filled in on a piece of paper.
So it's a unique positioning that Capitec clearly
Absolutely.
has. Well, let's get into the big question of the day: buy, hold, or sell? Let's get the answer from our experts. Capitec, the big question: buy, hold, sell, Peter?
I think it's run a bit hard in the short term. We like to say buy or sell. In this case, I'm going to say hold, but it is a share I really mean hold. I'd be happy to hold it for the next 5 years. The price comes off, I'm a very active buyer of it.
If it does come off, by how much? Because it is sitting at around, what, 530 now?
Yeah, I mean,
Any dip
we
is a
bought
buy.
it in our funds at around 200 Rand, probably less than a year ago. It's very difficult to be applying new money at this sort of price. But I think, probably becomes cheap again at 400. It's probably not a share you can ever buy that's cheap. But it's, if it came off 10%, psychologically it's a bit easier to buy.
Sean, you agree with Peter?
I think it's a very long-term buy, but I would not be surprised if the share price was the same level in 6 or 12 months' time.
He's saying the same thing as me.
But at that point in time, you must remember, with businesses that are growing 20 to 30% or 20 to 25% per annum, if the price does nothing, it's 20% cheaper in a year's time from a valuation point of view. So at that point in time, it would certainly be a compelling argument. I think it's valued like a high-growth industrial stock. That's what it looks like to me. Forward 19 PE for a business growing at 20%. It's many solid growth, solid industrial businesses that are growing at that rate attract that kind of rating. So it is expensive. We think they can grow. I think the price has run ahead of itself in the short term. But if I didn't have to report performance for the next 10 years, it's one I would own, certainly.
That's often what you must do with these high growth shares, as Sean's saying, is if they go nowhere for a year, that's often the time to buy it. Because the earnings are making it cheaper every month.
And what we've done from a client perspective personally is we've said to ourselves, Capitec is a great growth asset. It looks like it's run a bit ahead of itself, but we want to retain exposure to it. So we've said to ourselves, rather own it via PSG for now, because that's a more compelling valuation entry point, and it happens to be 50% of the value of PSG anyway.
Nice one to call then, quite clearly. Capitec, that is for today. A big thank you to both our guests, Peter Armitage and Sean Ashton of Anchor Capital. And you've heard the news. Buy on the dips and hold if you already have exposure to it. Well, that's where we leave it for this week. Do join us again next time where we talk more stocks.